Leverage is one of those words that makes half the room lean in and the other half break out in a cold sweat.
Yeah, that's pretty much the perfect way to describe it.
Right. Welcome to episode 19 of the Joinprop podcast. I'm the head of content here. Well, supposedly. Honestly, sometimes I wonder if my actual title should just be the guy who reads the dense financial white papers so you don't have to. But anyway, let me just pass this over.
Yeah, and I'm your co-host. I'm a freelance podcaster, and I am basically here to ask the incredibly dumb questions so that you, the listener, don't have to feel bad about not knowing this stuff. Because honestly, looking at the source material we have today, it's a lot.
It is a lot. The mission for this deep dive is to really unpack the actual grounded reality of leverage. Because if you go online, you look at prop firm marketing, it's just this wall of gamified jargon. They throw around terms like buying power and multipliers, but they never explain the plumbing. So we want to cut through that. We want to look at the capital efficiency of it all. Because when you drill down into the microstructure...
Oh, wait. Stop. That's right.
What? Capital efficiency. No, we are not doing that. You literally just said we were going to avoid jargon, and then 10 seconds later you hit me with capital efficiency. That sounds like a fake corporate buzzword. Let's start with basic numbers, please.
So the thing is, okay, wait, let me back up. You're right. Let's look at the pure mechanics of what's happening. Leverage is essentially a financial magnifying glass. Like, mechanically, it's a credit line. You put up a small deposit, and the broker fronts the rest of the money.
Right. So you're playing with the firm's money, basically.
Essentially, yes. Let's look at the standard prop firm model from our sources. Say you deposit, or rather you pass an evaluation and get access to an account with $10,000 of equity. The firm turns around and says, okay, we're granting you a 20-to-1 leverage ratio.
Which means, wait, do the math for me. 20 times 10,000.
200 grand. Your effective buying power in the market is $200,000.
Okay, so I put in 10 grand, but I get to swing around 200 grand like I'm some Wall Street hotshot. Yeah, exactly. You're swinging a position size that is totally disconnected from the actual cash sitting in your account. And here is where the math gets wild. If you're trading a $200,000 position, a really boring, tiny, 1% favorable move in the market.
Like just a normal Tuesday fluctuation.
Right. A 1% move on 200 grand is $2,000.
Okay.
But remember, your actual base capital is only $10,000. So that $2,000 gain, that is a 20% actual return on your money from a 1% market move.
Because of the 20-to-1 magnifier.
Exactly. Or even look at the stat from the data. A mere 0.5% edge in your trading can turn into a massive 10% return at 20-to-1 leverage. That is capital efficient. Sorry, that's why people use it.
I mean, it sounds like a magic money printer when you say it like that. But hold on, the reverse has to be true, right?
Wait, it's...
Because if a 0.5% move in my favor makes me 10%,
yeah,
then a 0.5% mistake means I lose 10% of my entire deposit instantly.
Yeah, I mean, bluntly, yes. I probably made it sound too exciting at first. The losses are equally magnified. That is the entire risk.
So a tiny little blip on the chart, just noise, could wipe out double digits of my money.
100%. And this gets into how the firms actually operate. Because if I'm taking a 200 grand position, where is that liquidity actually coming from? There's this concept of A booking versus B booking.
I saw this in the notes. Bring that down because it sounded sketchy.
It's just how the risk is managed. In an A-book model, the broker takes your trade and routes it directly to a major bank or liquidity provider. They're just the middleman. They make money on commissions.
Okay, that seems normal. What's the other one?
In a B-book model, the firm internalizes the risk. They take the other side of your trade. If you buy, they are the ones selling to you.
Wait, so I lose money on that magnified trade?
The firm makes that money directly.
That's literally their business model?
For a lot of them.
Yes.
If you are swinging max size, and that tiny 0.5% fluctuation hits your account, and you lose 10%...
the firm just pockets my loss.
Yes, the conflict of interest is baked into the plumbing.
That is insane. Why would anyone mathematically literate agree to that?
Because, well, legitimate professional traders don't use it to just gamble on one giant directional trade. The whole point of having greater capital isn't to take bigger risks, it's actually to spread it out. You use the margin to diversify across multiple markets.
So instead of putting all 200 grand on Bitcoin going up, you do what?
You put a little bit in foreign exchange A little bit in commodities. Maybe you run a complex hedging strategy where you buy one thing and short something similar. You need the extra buying power to hold all those positions at once. It's a tool, not a lottery ticket.
Okay, I guess I see the utility if you're doing complex arbitrage stuff. But let's be real about the numbers we're seeing in the source material. 20 to 1 is like the conservative end.
Oh, yeah, complete.
Some of these markets, these unregulated offshore firms, they are offering leverage ratios of 200 to 1.
Some go up to 400, honestly,
Yeah.
but yeah, 200 to 1 is common.
200 to 1. That means a 0.5% move against you wipes out your entire account. 100% gone.
Practically, you get margin called before it hits zero, but yes.
That feels like a scam.
It's not a scam.
I'm not saying illegal, I'm saying it feels like one. Handing someone a 200 to 1 multiplier is basically handing them a loaded gun and pointing it at their foot, especially if the firm is B-booking them.
Look, I get why it feels predatory.
Yeah.
And for retail traders who don't know what they're doing, it absolutely is a meat grinder. But the industry defends it. They argue it's a competitive necessity.
A competitive necessity to blow up their own clients.
No, to attract top talent. If you are a brilliant algorithmic trader and you have a system that makes thousands of trades a day with a microscopic razor-thin edge, you need massive leverage to make those tiny edges actually generate real money. If firm A offers 30 to 1 and firm B offers 200 to 1, that top-tier talent is going to firm B.
Even knowing the risk of ruin is that high.
Yes, because, and this is the crucial reality check here, this is the whole secret to the industry. The successful prop traders, the ones actually surviving, they only ever use an effective leverage of between 5 to 1 and 20 to 1, even when 200 to 1 is available.
Wait, so they demand the firm offer it, but they never actually use it?
Exactly. It's a ceiling, not a target. They want it there just in case they need to throw on a massive intraday hedge for 5 minutes during a crazy news event without getting a margin-rejected error. But they aren't actively risking that much capital.
I am deeply skeptical of that. You're telling me firms dangle this insane 200.1 carrot just for the 1% of pros who need a temporary buffer. They know exactly what they're doing. They know human psychology guarantees the amateurs are going to max that slider out.
Oh, totally. The amateurs see the 200 to 1. They do the math on how rich they can get by Friday. They max their size, and they're liquidated in 4 seconds. But the pros survive because they use very specific risk models to protect themselves from that exact temptation.
Which brings us to the actual rules of survival. What are these pros doing differently?
It all comes down to the 1 to 2% rule.
Okay, lay it out.
Professional traders will risk no more than 1 to 2% of their total capital on any single trade, period, regardless of how confident they are.
So on a $10,000 account,
your maximum loss on a single idea is 100 to 200 bucks.
See, I struggle with the psychology of this.
Why? It's just basic math.
Because it's unnatural. Imagine you are a trader, you're staring at your screen, you've spent hours doing fundamental analysis, your technical indicators are literally screaming by, and you are, let's say, 100% confident in the setup. It's a sure thing.
There are no sure things.
But you feel like it is. If you were sitting on a 200.1 multiplier, risking 1% feels like a joke. Why not risk 10% if you know you're right? You press the advantage.
Because your confidence is completely irrelevant in the face of leverage. You can be right about the chart and still lose everything because of systemic risk.
Systemic risk. Great. More textbook terms.
Okay, I mean black swan events. Things you literally cannot predict.
Right, but explain a black swan without sounding like a finance professor. Give me a real-world example of how my 80% confidence trade blows up.
Okay, let's talk about the Swiss franc. January 2015.
Okay.
For years, the Swiss National Bank had this artificial floor, a peg, on the euro to Swiss franc exchange rate. At 1.20, it was the safest trade in the world. The central bank promised they would defend that price.
So everyone just bought it whenever it got close to 1.20?
Yes, everyone. Massive institutions, retail traders, all heavily leveraged because it was a sure thing. And then, one random morning, the central bank just dropped the peg. Without warning.
Oh, wow.
Yeah. And the market didn't just slowly tick down so you could get out, it gapped. The instant the news hit, every single buyer in the world canceled their orders. The order book was literally empty.
Meaning if you wanted to sell to stop your loss, there was nobody to buy it from you?
Exactly. If you were leveraged at 20 to 1 and you put 10% of your account on that sure thing, relying on a stop-loss order to protect you, the stop-loss didn't work. The price fell through empty space. It dropped 30% in minutes.
So you're 10% risk.
A 30% drop on a 20-to-1 leveraged position is a 600% loss.
Wait, a 600% loss.
Yes, you didn't just lose the 10% you risked. You didn't just lose your whole account. You literally owed the broker 5 times your initial deposit in 3 seconds.
Oh my God.
Exactly.
Mm.
Accounts went massively negative. Brokerages actually went bankrupt that afternoon. And that is why you never, ever break the 1 to 2% rule. Because on any given Tuesday, the global financial system can break. And you need your account to be small enough to survive the shockwave.
Okay, I hear the math, but I still say human nature makes that rule almost impossible to follow.
It takes discipline, sure.
No, it's more than discipline. It's biological. Humans are greedy.
Well, the way the pros handle the biology of it is through gradual scaling. You don't just jump into the deep end at 20-to-1. You start at maybe 2-to-1 or 5-to-1. Very slow.
Which is boring.
It's incredibly boring. Good trading is boring. You only increase your leverage when your consistency is proven over months. But the really hard part, and the source material explicitly calls this out, is that you must reduce your leverage during underperformance.
Yeah, I flagged that in the notes too, because that is the exact opposite of what the human brain wants to do.
What do you mean?
Think about when people lose money. If you go to Vegas, right? You lose $100 at the blackjack table. Do you immediately say, oh, I'm underperforming, I should only bet $5 a hand now?
No, you bet 200 to win it back.
Exactly. It's revenge trading. When you lose money, it triggers physical pain in your brain. And your biological instinct is to fix that pain immediately. So if a trader is losing, their human instinct is to increase their leverage, not decrease it.
I completely, vehemently agree with you. You're so right. That is why leverage is so dangerous. It intensifies your emotional decision-making.
Because the numbers are bigger.
Yeah. A small market swing suddenly looks like a mortgage payment flashing red on your screen, and you panic. Honestly, the hardest part of prop trading isn't finding a good strategy. It's overriding the biological urge to double down when you're hurt.
So how do you override it? Because just saying follow the rules clearly doesn't work for 90% of people.
You have to use objective metrics to force your hand, like volatility-adjusted leverage.
Measuring by the VIX.
Yeah, the VIX, the volatility index. If the market is acting completely crazy and whipping around, meaning the VIX is spiking, you've systematically reduced your leverage.
Because the market is covering more distance, so you need wider stops.
Precisely.
Yeah.
To keep your risk at that strict 1%, if your stop loss has to be wider to avoid the crazy swings, your position size has to be smaller.
Okay, that's mathematical. I like that.
And the other objective rule is strategic deleveraging.
Which means pulling back after a win.
Yes, actively reducing your leverage after a massive, highly profitable trade.
See, that also feels weird. If you just had a huge win, aren't you in the zone? Shouldn't you press the gas pedal?
No, because of the God complex. When you hit a massive leveraged win, your brain floods with dopamine. You feel invincible. You think you can see the matrix. And that is exactly when you get sloppy.
So you start forcing bad trades because you want another hit of dopamine.
Exactly. The market will always revert to the mean and humble you. Strategic deleveraging forces you to take your ego out of it, secure the profits, and reset to baseline.
Okay, I respect that. That's an actual structural defense against human stupidity.
There is one more defense mentioned in the reading, though it's a bit more subjective, the sleep test.
Oh, I hated this part of the reading.
Really? Why? The rule is just, if your current leverage keeps you awake at night or has you constantly checking your phone, your leverage is too high.
I aggressively mock the sleep test.
Seriously, it's a great heuristic.
It is a pathetic risk management strategy. You're telling me a multi-million-dollar financial firm is relying on a trader's sleep quality? That's pseudopsychology. Firms should have hard, unbendable API rules that physically prevent you from risking too much, instead of asking if your tummy hurts at 3 a.m.
I think you're looking at it wrong. Prop trading is inherently psychological. I don't care how many hard-coded algorithms a firm has. If a trader lacks self-regulation, they will find a way to blow up.
How? If the computer locks them out, they can't trade.
They will open an offshore account. They will jump on their phone and trade crypto on a different exchange. They will over-leverage somewhere else. No algorithm can save a trader who is fundamentally broken inside.
But using anxiety as a metric, that's ridiculous.
It's not ridiculous, it's biology. If you're checking your phone in the middle of the night, it means your subconscious knows your position sizing represents a material threat to your financial survival. The system hasn't failed you. You failed your own risk management.
I still say the firms need to enforce it better.
But self-regulation is the only ultimate filter. If you can't pass the sleep test, you are eventually going to panic, close a winning trade too early, or hold a losing trade until you blow up. The anxiety is the warning bell that the math is wrong.
Fine, I still think it's a soft metric, but I see your point. If you're sweating, you're gambling.
Exactly. You're gambling.
Yeah. It's a lot. Just unpacking this, I feel
Me
exhausted.
too.
Yeah.
It's heavy stuff. Let's decompress for a second here. If you had to pull out one biggest, rawest takeaway from all this source material, what is it?
The disconnect, without a doubt. The massive glaring disconnect between what this industry advertises, the 200.1 multipliers, the gamified dashboards, and what the people who actually survive use. They advertise 200.1, but the pros use 5.1 to 20.1. It's like selling someone a rocket ship, but telling them the only way to survive the commute is to drive it like a golf cart. It just feels predatory.
That is a phenomenal way to put it. For me, it's the absolute rigidity of the 1% to 2% rule. It doesn't matter if you feel like a genius. It doesn't matter if you're on a hot streak. The math does not care about your feelings, and if you think you're the exception, a black swan event will eventually find you.
A Swiss franc story is going to haunt me.
Yeah, it haunts a lot of people.
Mhm.
But look, I want to leave you listening right now with a final thought to chew on. We spent this whole time talking about how leverage amplifies everything, the good, the bad, and especially your own emotional flaws. So if you are currently hunting for the prop firm that offers the highest possible leverage, what does that actually say about you? Does it mean you have ultimate confidence in your trading strategy? Or does it mean you have a secret desire to just gamble, skip the hard work, and get rich quick?
Ouch. Calling them out.
Hey, the market will call them out eventually. Might as well do it here first. Anyway, that's all we've got for today. Next time, we're going to get into the actual statistical weeds of passing these prop firm evaluations, which is a whole other psychological minefield. So, catch you next time.
Catch you later. Watch your stops.